Open your banking app right now. Look at what you were paid last month. If your balance is $5,000, your bank probably handed you somewhere between a few cents and $1.63. Now consider this. Your bank took that same $5,000, lent a portion of it out at rates between 6 and 12%, and kept the difference. All of it. That model has worked for thousands of years, and nobody ever explains it to you. We started Telus because we thought you deserved a better deal. We built a financial product that rewards you for the habits you build with your money. The rewards you receive are driven by the goals you set and the actions you take every day. And the company behind it is built on something tangible: real estate, real properties, real tenants, real loans, real collateral. Houses that people live in, houses you can point to on a map. No vague hand waving, no skipping the hard parts. Let's start with the banks. To understand what we do, it helps to understand what banks do, because the comparison makes everything else click. Banks take deposits, they lend those deposits out at a higher rate, they keep the gap. The industry calls that gap net interest margin. According to the FDIC's quarterly banking profile for Q4 2025, the banking industry's net interest margin was 3.39%, the highest it has been since 2019. The industry reported $295.6 billion in full year 2025 net income. That number was built largely on the distance between what banks pay depositors and what they charge borrowers. Meanwhile, the national average rate paid on the standard deposit account in the US is 0.39%, according to the FDIC's data published in December 2025. Some of the largest banks in the country pay as little as 0.01% on checking accounts. So the depositor accepts pennies. The bank collects hundreds of billions. That is the system most people's money sit inside right now. This is where most fintech explanations go vague. We'd rather not. Telus operates a real estate lending business. We make short-term loans against non-owner occupied residential property. Think of it like this. Imagine someone buys a rundown house, renovates it, and either sells it or rents it out. They need short-term capital to make that happen. That's the loan we provide. Our borrowers are fix and flip operators, landlords pulling equity from rental properties, and developers doing small-scale residential construction. The average yield on our loan portfolio in Q1 2026 was approximately 10.3%. After 2008, many large banks pulled back from this category. Non-owner occupied loans are harder to bundle and sell on secondary markets. They tie up capital in ways that bigger institutions increasingly avoid. That pullback created a gap. Small hard money lenders partially fill it, but they tend to charge 12 to 15% or more and provide inconsistent service. We operate in the middle, more professional and lower cost than hard money, more flexible and responsive than banks. Our underwriting evaluates the property itself, its location, condition, value, and rental income potential, rather than relying primarily on borrower credit scores. Think of it this way. Outside the US, where there's no equivalent of a FICO score and no government-sponsored entities buying up conforming loans, lenders evaluate the asset. That's actually how most of the world does real estate lending. We applied that same logic here. Every loan is collateralized by physical residential real estate. If a borrower defaults, we can foreclose and recover the asset. To date, 2 foreclosures have occurred in our portfolio. We have not taken a loss on the loan to date. The properties were recovered and we were made whole through the collateral. That lending revenue is how Telus makes money. No hidden fee structure, no payment for order flow, no interchange income, no data monetization. We will tell anyone who asks exactly how the economics work. The next question is whether demand for these loans hold. The US housing supply gap widened to an estimated 4 million homes in 2025, according to Realtor.com's 2026 Housing Supply Gap Report. The National Association of Home Builders chief economist Rob Dietz has said publicly that it took about a decade to get into this deficit, and it will probably take about a decade to get out. Americans need places to live, and the supply is chronically short. That means persistent demand for the kinds of short-term real estate lending we do. The borrowers exist because the housing shortage exists, and the housing shortage, by every credible estimate, is measured in years, not months. Telus is working to address that shortage from two sides. The lending business provides capital to investors who buy, renovate, and build residential property. The property management software helps the independent landlords who own and operate those rentals. The mom and pop owners who manage 1, 2, 5 properties and need better tools to do it well. One side funds the housing, the other side helps maintain it. Your experience as an account holder works differently from the lending side of the business. The rewards you receive on Telus are driven by your behavior, the goals you set, the daily activities you complete, the consistency you show. The US personal saving rate was 3.6% as of December 2025, according to the Bureau of Economic Analysis. One reason it stays so low is that for most people, the experience of setting money aside is deeply unrewarding. You move cash somewhere, a quarterly statement arrives showing a few cents, and nothing visible changes. The behavior gets no reinforcement, so it doesn't stick. We developed Telus around the opposite principle. Rewards compound daily, and they're driven by what you actually do. Logging in, completing a daily quiz, activating boosts, and setting goals through stacks. Stacks are named buckets inside your account for things like an emergency fund, a vacation, or a down payment. Account holders who actively engage earn rewards between 5.59% APY and 7.75% APY, paid and compounded daily. Behavior research shows that people who attach their money to a named purpose are more likely to keep it there. A balance labeled emergency fund feels different from an undifferentiated number. That friction is intentional. The confetti, quizzes, and streaks may or may not appeal to you personally, but the underlying function is real, helping as many people as possible hit their goals by making the act of building your cash something you can see and feel every day. At a 3.6% national saving rate, the old approach clearly is not working. Telus does not hold a banking charter. The Boost, Reserve, and Vault accounts are not bank accounts and are not FDIC insured. We disclose this prominently and repeatedly. You're not buying something that trades in the markets with a price bouncing up and down. You're not trading at all, and you can withdraw anytime. No gates, no lockups. If the word fintech makes you think of Celsius, Voyager, Synapse, or FTX, that skepticism is earned. Those companies failed for specific documented reasons: misuse of customer funds, fraud, lack of collateral, opaque business models. Telus is powered by real estate. The loans are short-term, the collateral is real, the business model is transparent, the company is profitable and not dependent on further fundraising to operate. There are real risks, and anyone considering Telus should understand them. If the real estate market experiences a severe downturn, collateral values could decline. If a large number of borrowers defaulted simultaneously, the company would have to work through that the same way any lender would. We've been doing this since 2016. We have not taken a loss on the loan to date. That record is real. So are the risks. Both deserve your attention. Telus occupies a specific slot in your financial life. Liquid cash you want working harder, separate from your long-term investments. Set up a stack for your emergency fund. Claim your daily boost. Name a goal, fund it on your schedule, and let your consistency drive your rewards. If you're building a long-term retirement portfolio, equities and diversified funds still play that role. When you hit your near-term goals first, you free up that much more room for your portfolio to run. The question most people ask when they first hear about Telus is, why didn't this exist before? The answer is that most companies pick only one lane. We built the whole stack. A property management data layer where the company started back in 2016, a lending operation, an underwriting model, a consumer-facing product, and the technology to connect all of that together. That's why it took years. And that's why the model works. Open a free account at telusapp.com. Set up your first stack. Name it something real, something you actually want. Then come back tomorrow and see what your consistency earned you overnight. Subscribe. We're going to keep pulling this curtain back.